So hello, my colleagues, and I do hope everyone is well this morning. It's about 5:26 in the morning on a Friday, and happy Friday to everybody. So I want to pick up here with chapter 6, and this is probably the most important thing, bond yields. Okay, so we're going to talk about bond yields this morning. And yields come in a variety of names. And basically, you'll see the word yield. Okay, and there's a lot of different terms. The term has slightly different meanings in different contexts. The three most widely reported measures of a bond's return are its current yield, its yield to maturity, and its yield to call. And and everyone should remember what a bond is when it's called, right? They call it back early so they can redo their interest at a lower rate, right? They have to refinance their debt at a lower rate. So the current yield is basically the annual coupon or interest payment. So there's a couple different words that are used for the money you get every 6 months, right? And it's called the annual coupon payment or annual interest payment. And you divide that by the current price of the bond, and you'll get the current yield. Now, I want to make something very clear. Bond prices, change every minute of every day. A bond price is has an inverse relationship to its yield. So as the yield goes down on new issues, the bond prices go up. Okay, so it's an inverted convex curve. So that's very important, okay? So don't ever say, what's the current price of a bond? And it's not what you paid for it. As soon as you buy a bond, the prices fluctuate every moment of every day. That's important. So $1,000 par value bond, now assuming it stays at par, with an 8% coupon rate, right? And that means you'll get $80 a year or $40 every 2 years. That currently sells for $970. So you see how the price has changed, right? Would have a current yield of 8.25%, right? 80 divided by 970. So that's going to measure how much interest the bondholder receives as a percentage of the bond's market price. Okay, and that's an important statement here. That's a real important statement here. Okay. However, a bond's total return depends not just on the interest payments it makes, but also on the change in the bond's price that occurs. Because it focuses only on the interest that a bond pays, the current yield is not an especially accurate measure of a bond's rate of return. Both the yield to maturity and the yield to call measure provides a more complete picture of a bond's return, and we'll look at those in a bit, okay? So that's an important statement. All right, so bond prices, as I said, start out when you buy a brand new issue at par. So most corporate bonds are purchased and held by institutional investors such as banks, insurance companies, and mutual funds rather than individuals. But you can buy, and I own bonds, right? Bond trading and price data are not readily available to individuals, but you'd have to call a broker. So we can look at a table here. Let's click on this table, and it scrolls down, and you can see different companies here, right? Verizon, and here's the coupon it's paying. That's the annual rate you'll get if you bought that bond. This is the current price. You can see the price has gone down. Okay, the price has gone down. So here's what's interesting. When you bought the bond at par or $1,000, this was the coupon, but the price has gone down. So look what the yield to maturity is. The yield to maturity has gone up. Okay, so as the price goes down, the yield goes up. And look at this now. The price has gone up here for Ford. And this was the coupon, and the yield has gone down. Okay, And the same thing for Marathon, okay? So that's the way that goes. So we look at those prices. So the second column will show the Verizon's bond has the coupon, and the third column indicates the bond matures in 2048. That's the date you'll get your money back. You always get your money back, unless the bond is in default. The fourth column will list the closing price expressed as a percentage of the bond's par value. Most corporate bonds are issued with, now here's the important terms that are used interchangeably. A par or a face value, okay, of $1,000, okay? So that's all saying the same thing, okay? The Verizon bond has a $1,000 par value and is quoted at $91.98 or $919.80. That's the current price someone would buy it off you. So it went down in value. So the final column is going to give you the bond's yield to maturity, is the compound annual rate of return that would be earned on the bond if it were purchased and held to maturity. Okay? So that's another important statement, and this is an important term, yield to maturity. So given its current coupon rate and its price, the Verizon bond offers a yield to maturity of 5.033%. So that is above the coupon rate, and you can see that the bond sells below its $1,000 par value. So an investor who buys the bond today and holds it until it matures will receive interest payments of $45.22 each year. And there's a capital gain, okay? There's a capital gain if someone bought it at this price, because they would get $1,000 when it matures. So the capital gain component adds to the bond's total return. So that's going to boost the basically total return, and it's going to boost the yield to maturity above its coupon rate. So that's what goes on with that. Okay. And here is the different companies, and here's their coupons, and this is when they mature, and this is the price and the yield. Okay. Now, depending on the quality of the bond or the default risk of the company, bonds have a rating, and there's agencies that rate bonds, and you may have heard of them: Moody's, Fitch, Standard & Poor's. Right? You may have heard of these companies, and they basically bond rating companies. And they assess the riskiness of publicly traded bonds. So you can see the different ratings here and how they're interpreted. So Moody's uses these ratings, and Standard & Poor's uses these ratings. So here's the interpretation for Moody's, and here's the interpretation for Standard & Poor's. So you can see when you start hitting around B, sub A for Moody's, and double B for Standard & Poor's, they start becoming kind of junk. Okay? They start becoming junk. So you can see the grades go down to like about a C here and a C here. So that's the way bonds are graded by the two companies. All right. So, and there's a nice article here about bond ratings being trusted, because in 2008 there was like a scam that went on, and bond rating companies were in cahoots with the mortgage, the banks and everything, and the ratings weren't true. There was a lot of scams that went on. So Moody's got in trouble. Moody's had to downgrade 80% of the billion in mortgage-backed securities, rated AAA. So it's an interesting read to see what happened in the 2008. You should read that. So there's an inverse relationship that exists between the quality of a bond and the rate of return that it must provide bondholders. So high quality bonds provide lower returns than lower quality bonds, right? So if because it's high quality, you're going to get a lower return, right? and because you're taking less risk, less return, right? The higher the risk, the more return, right? So that's an important thing. All right, so there's many different types of bonds here, and they come in all different types of names. So this is a really nice way that bonds are classified. Nice table they gave you here. And, you know, they've been around for a long time. And this, you should go, here's unsecured bonds, otherwise known as debentures. And this is a standard bond you would buy, right? It's called the debentures. And only credit-worthy companies issue these. And these can be convertibles. You can convert them to shares of stock. All right. And subordinated debentures. Claims are not class satisfied until those of the creditors holding certain senior debt have been fully satisfied. All right. And so, again, there's many. Now, here's secured types of bonds, right? These are secured bonds. And here are more different types. And these have different names now. These are zeros, coupons, junk, as we talked about, floating rate, extendable notes, and puttable bonds. Okay, so these are interesting types of bonds. The zero coupon bond you buy at a big discount, and there's no coupons, such the name zero coupon. So they're issued with no coupon, and you just buy them at a deep discount, and you get your money back at the end. Junk bonds, again, are bonds that are close to being in default, and you basically will get a higher rate of return, but you're taking a lot more risk with this. So this is important to know. So these are nice tables here of bonds, and it's good to know about. And here's a nice section on you can do international bonds, and they define here a Eurobond. And a Eurobond is a bond issued by an international borrower and sold to investors in countries with currencies other than the currency in which the bond is denominated. So that's an important statement, right? So that's the difference in a bond, okay? So you would have a dollar-denominated bond issued by a U.S. corporation and sold to Belgian investors, right? So it's being sold in Belgium, but it's in dollars, okay? So that's an important thing to know. Okay, and then there's another term called a foreign bond, and that's issued by a foreign corporation or government and is denominated in the investor's home currency and sold in the investor's home market. Okay, so just be aware of these different types of bonds, okay? So that's it for that, I think for that. So here's some nice review questions. Again, you should go over those on your own. And all right, so now we're going to start looking at how to value bonds. And the question is, how much should I pay for a bond? And valuation is basically the process that will link risk and return to determine the price of the bond. So what we got to do now is understand how to get the price of a bond. And as you might imagine, there are equations, but on the other hand, Microsoft Excel is your best friend and will help you with this. And it's really not a hard equation, but it's based on the expected coupons you get and the price you pay for the bond. Okay. So evaluation is important because you want to know how much you should pay for something. All right. So valuation has three key inputs: cash flows, timing, and a measure of risk which determines the required return. So these are important things to know. Okay, so the value of any type of thing, any type of value, is going to be determined by cash flows that are expected to provide over time. So if you're going to buy a company, right? If you hear companies buying each other, they determine it. They're saying, I'll pay you like billions of dollars because I expect cash flows to be coming in to give me a higher net present value, which we'll talk about later. Okay. So you can see in this example here, they have an example of valuation, and they value a bunch of things. Stocks. This person, Celia, owns stocks. She owns shares in, I guess, in an oil well. And she owns a piece of artwork. And she's trying to understand how to value them all. And she'd go through that, okay? All right, so I'm going to pick up and we'll look at that valuation example next time, because I'm about 16 minutes into this now. So you'll see in a bit we'll return to Celia's problem and we'll value those together. And we'll pick up here at timing, okay? All right, everybody, have a good one. Stay safe. Have a good weekend.